Japanese stocks plunged again today, and the yen is moving higher. US tech stocks and the AI bubble took a hit yesterday, raising way too many similarities to the early part of last month. And all of it related to recession fears that people just were not ready for, despite the buildup of warning signs all along the last couple months. More than that, people are really beginning to understand these are not just fears. The US government reported more alarming labor data earlier today, with job openings plunging, hiring still incredibly weak, plus now the highest level of layoffs since last March during the banking crisis. The yen carry trade didn't stop unwinding after early August. It was just less disorderly and chaotic. But if you weren't watching closely or you were glued only to the stock market, you would have missed the disorder picking back up from the middle of last month up to now. What was most significant about the stock market crash in Tokyo back then, as well as today, is that it showed just how fragile the global system is when it's forced to reprice systemic risk. That's what's still happening, and the warning signs, as I said, have been all over the place. I mean, commodities are down again, oil is plunging, gasoline incredibly low. I've shown you the copper to gold ratio, swap spreads, both huge warnings. We'll update the yield curve and forward rates here, where SOFR futures are pricing the next steps for all of that. Some of those contracts in SOFR futures are already back to where they were in early August. Even central bankers are now clearly uncomfortable. The Canadians, for example, they did another rate cut today, their third in a row, showing that once central bankers start, they don't stop. There's always a series of rate cuts because they underestimate the weakening. And because rate cuts don't do anything, officials have to keep on chasing that weakening as it gets, well, weaker. All of this may have seemed like nothing just a month and a half ago, but even Jay Powell has thrown in the towel and changed his tune, though he's the last person you should rely on. We've had warnings after warning, yet they were ignored under strong and resilient and all of that. It's gotten to the point, though, that the warnings can no longer be ignored. Even mainstream economists are starting to sweat. In response to the JOLTS data today on CNBC, one of those mainstream economists said, "The labor market is no longer cooling down to its pre-pandemic temperature. It's dropped past it." That's Nick Bunker, who's the head of economic research at Indeed Hiring Lab. Nobody, and certainly not policymakers at the Federal Reserve, should want the labor market to get any cooler at this point. And that's the point. It's too late. Even the central bankers of the Federal Reserve realize this, which is why Jay Powell was singing a vastly different tune at Jackson Hole late last month. He even said the unemployment rate has not only has it gone too high, the speed at which it has gone higher more recently has them clearly unnerved. So the Fed is going to act like the Bank of Canada is already acting, and all of it in response to what's unfolding. It's no longer just some future distant possible risk. It's our current reality. And that reality showed up in the share prices of Japanese stocks yet again. Go back to CNBC from earlier this morning in Tokyo trading. Asia Pacific markets plunged on Wednesday, led by Nikkei 225 and Taiwan's Taiex after US tech stocks sold off. And here's the thing. Weak U.S. economic data sparked recession fears. No, it didn't spark recession fears. It further confirmed recession reality. Japan's Nikkei 225 fell 4.24% to close at 37,047.61, while the broad-based Taiex dropped 3.65% to 2633.49. Both indexes saw their worst one-day loss since the August 5th sell-off. And even more concerning, Japan's yen is strengthening all over again. And that word strengthening is not appropriate for what we're talking about here. The yen isn't strengthening, it's the carry trade being reversed. And as of this morning, the JPY was at 144.24, which is not that far off of its high from August 5th at 143.95. That disorderly high of 143.95. The yen goes up. That's the carry trade reversing. That's what we're really talking about here. What is this yen carry trade and why does it matter so much? And the answer is not central bank rate hikes. Is what you'll hear a lot of is it's the Bank of Japan or the Fed on one side. The interest rate differentials are now unfavorable to US dollar assets, and so a lot of Japanese resources have to flood back into the yen and come home. But how would that lead to crash in Tokyo stocks. All this yen coming home to Tokyo wouldn't lead to liquidations in Tokyo stocks. Instead, the yen carry trade is about Japanese financial firms who have been expanding their portfolios and using massive amounts of leverage to do so out there in the Eurodollar system, either to buy US dollar assets directly or to use the Eurodollar to intermediate into other currency denominated assets as well. And the Japanese, being highly leveraged, swapping into US dollars, they're doing so not because of strictly interest rate differentials, but because of the risk-adjusted return characteristics of assets all over the planet, including US dollar terms. So long as the risks are perceived to be low, Japanese want to do it. They want to use their yen, which they have tons of, as collateral, swapping into US dollars, and then buying either US dollar assets, riskier US dollar assets, or other risky assets around the world, so long as those risks are perceived to be low. And that was the trigger earlier in August, really late July, going all the way back into May and June. Basically, Japanese firms bought into the soft landing in the United States and thought the risks of owning risky financial assets were incredibly low. And over the last several months, they've come to realize that that might have been a large mistake. And as the data further and further confirmed, as other markets further and further confirmed that the US risks were not low, it led to a scramble toward the exits, especially focused in acute way late July and early August. It led to a disorderly unwind, which showed just how fragile this financial system is when it is forced to confront and reprice systemic risk. We know it's not interest rates. In fact, interest rates are telling us the exact opposite. JGB yields, for example, they're trading in tandem with global bond markets, with the exception of the Bank of Japan's short-run interference on the front end of the curve. If this was about interest rates, then we would have seen this carry trade unwind back in April and late May when market yields were going much higher. For example, the JGB 10-year yield was almost 1.1% on May 29th. So the 2-year JGB yield was 0.4% on June 3rd. If this was about interest rates and interest rate differentials, then you would have seen that happen back at the end of April and into May, not late July into early August. What changed was the risk perceptions of owning US dollar and related assets and swapping through US dollars into other assets in a situation where the US economy is not fine and it is not low risk. So that's why you see JGB yields peaking in late May along with, say, German interest rates. The reason all of these markets, the global bond market, has shifted now toward lower interest rates is because we're getting more confirmation. Globally synchronized includes the US economy. So as the Japanese are forced to confront risks that they weren't willing to confront before, they're getting confirmation from a number of different directions. As I mentioned, commodity prices. I've done videos this week on gasoline and oil. Those continue to move lower. WTI crude, the US oil benchmark, is under $70 per barrel. Gasoline prices have fallen to around $1.95 wholesale, its lowest closing price since April of 2021. So material weakness in energy markets that goes along and really emphasizes the message that we're getting here. The US economy is not fine. This isn't just about China. This is indeed globally synchronized. And we're seeing that as well in terms of what central bankers are being forced to do too. Get another reminder today from our friends up north in Canada. The Bank of Canada cut rates for the third time in a row, and the Bank of Canada officials said there's a lot more coming. With inflation getting closer to the target, we need to increasingly guard against the risk that the economy is too weak and inflation falls too much. That, according to Tiff Macklem, the most perfect central banker name ever, that's what he said in his prepared remarks at his press conference earlier today. We care as much about inflation being below the target as we do above. They're being forced to reprice risks themselves, from sticky consumer prices only several months ago to now, wait a minute, we might be talking about risks to consumer prices going under the target, undershooting what these central bankers would like to see from consumer prices because of how much material weakness there is in the entire global economy. The world is being forced to confront repricing systemic risk from the US is just fine, strong, and resilient to, oh crap, the Fed needs to do a lot of rate cuts too. When we're talking about the Fed needs to do a lot of rate cuts, it's not because the rate cuts will help, but the Fed reacts to the weakness that now is apparent all across the global economy and the US labor market, as I'll go over in just a moment. We see this in the expectations priced into forward rate markets like SOFR futures. Now, those had absolutely skyrocketed in price, which means plunging expectations for forward interest rates, certainly back in the early part of August when there was chaos and liquidations and everything else. What people may be surprised about is that markets like SOFR futures, like the Treasury curve or JGBs or any interest rate markets, interest rate swap spreads, haven't really moved all that much since early August. And in terms of SOFR futures specifically, some of the contracts are only a couple basis points from those extreme levels early in August, on August 5th, August 2nd. For example, the December 2024 contract for term SOFR futures, that priced out at 95.92. That was the highest price, which means the lowest implied forward rates. That was back on August 5th. And then it backed off a little bit to the middle of last month, August 15th. But as of this morning, the December 2024 contract is back to 95.835. Really, and I've seen it as high as 95.85. So getting really close to that high price in the extreme from earlier in August. The June 2025 contract, that one got to as high as 96.71. Again, that's in price on August 2nd, which is the lower implied forward yield. And it had been 96.67 on August 5th. And then it backed off like everything else to the middle of last month. But as you continue to see in interest rate prices, in interest rates and yields, as well as futures prices, everything turned around and moved back in the wrong direction over the last half of last month, really since August 15th. So while everybody was paying attention to stocks, the marketplace, the real marketplace, was moving back in the direction of early August. And what that suggests is that the market continues to expect a strong, aggressive series of interest rate cuts from the Federal Reserve. Not just one or two, September and maybe by January. We're talking about likely a 50 to start with and then several more right after that. So the forward interest rate markets haven't changed their determination about what's likely to happen in the near term. So the curve is still focused on that March to June window on the futures curve, suggesting that whatever's going to happen in the near term here, likely a recession, it's going to strike before we get to the middle of next year. The worst part of it, or the most recognizable part of it, will happen before March to June 2025. Because the weakness isn't just about what's happening in front of us, it's likely to be beyond it in terms of what the longer run consequences to a U.S. falling into recession at this point might actually be. But that's a separate conversation that I've had before in a previous video, and one that we'll continue to come back to over the next little while here. And to that end, the U.S. government reported in JOLTS today job openings. Now, job openings is not one you should put too much reliance into. You just should not have a whole lot of confidence in the numbers. So we only bring it up because, first of all, the mainstream still looks at job openings as if it is a accurate measure of demand for work in the economy. So we look at JOLTS job openings as the best possible look at the labor market demand. And if that one is falling off precipitously, as the latest data shows, then it's very likely that the labor market overall is indeed in serious trouble. If the best possible measure is falling off precipitously, then there's a high chance that we're seeing some substantial weakening in the actual labor market too. Job openings fell in the month of July 2024 to 7.67 million. That's down from a revised 7.91 million in June. The hiring rate rebounded in July, but only partially from a downward revised, really shocking level in the month of June. So that's not good. Hires continue to be incredibly weak. Very much consistent with at least half the recession that the U.S. economy has been experiencing since last year. Quits were basically unchanged June and July at a low level, suggesting that American workers know that the economy is in the labor market is not strong. It's actually very weak. And maybe one of the surprising standouts, layoffs and discharges. According to JOLTS, layoffs jumped to 1.76 million, which was the highest since March of 2023. Now, it's not a huge number, But at 1.76 million, it's about another example showing that the labor market is indeed likely changing and experiencing more negative pressures on it. So with job openings going down, the best possible measure of the labor market, hires incredibly weak, quits down low, and now layoffs jumping up a little bit too here, it's not a good sign of the labor market. It's more evidence that things are indeed changing in the wrong direction. And we got that yesterday. What really triggered the sell-off in tech stocks was the fact that the ISM manufacturing index came out. That was incredibly weak. 47.2 was only up a little bit from the July number. New orders sunk to their lowest level since May of 2023. And the employment index for the ISM manufacturing, even though that was higher than in July, at 46.0, it's another indication of very weak labor market conditions. So this isn't about central banks one way or the other. This is about the world having to reprice and having to confront the fact that globally synchronized is a thing, and the US economy is synchronizing to global recession. It isn't about rate hikes from the Bank of Japan. That's not the reason why we get this unwind in the carry trade, nor is it about the Fed's rate cuts, which will be, like the Bank of Canada's, a response to growing weakness, really recognition of weakness that's already been building up. The yen carry trade is about Japanese financials who have been under the impression that the U.S. economy would be fine, that there's very low risk in engaging in these carry trades and tactics, and instead having to come and confront the same types of repricing that we're talking about here. The idea the U.S. is not fine. And when the U.S. is not fine, it changes a whole lot. And with all this financial volatility being unleashed by the carry trade unwind, that's just a reminder the system wasn't prepared for this, at least these parts of this, the risky parts of the system, which had been too complacent about the risk all along, and that it's fragile, far more fragile than people realize, and certainly what we've been told from policymakers and officials all along. So all of this is just the realization that U.S. recession risk isn't small, nor is it really about risk. And there are very deep and profound long-run consequences to this, that we didn't escape the pandemic and the supply shock as easily as it may have seemed under the U.S. soft landing. That's where copper to gold ratios are. That's where the swap spreads have been. That's where the treasury yield curve is going. That's where the JGBs and European rates and forward markets are heading. It's where commodities are crashing to. It's where even central bankers are starting to realize it's not just a trivial risk. This Japanese carry trade is highly misunderstood. It's not about interest rates one way or another, certainly not about central banks, and I talked about it in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and Eurodollar University subscribers, and until next time, take care.